a lot of people realize this. If you look at Saylor and Strategy, he's buying anytime. Like it doesn't matter if it's a top. He doesn't care about dips because there is this urgency because the time is running out to buy Bitcoin at these low prices. So we're going to see a fast run up, and gold is a good parallel for what we're likely to experience with Bitcoin. If you look at the picture circulating right now on the internet, there are people lining up, forming queues to buy gold, and gold is at an all-time high. So nobody wants Bitcoin when it's in the low 100Ks, but once we get to like $500,000 per Bitcoin, I think the world's going to wake up, central banks are going to wake up, and nation states are going to start joining the race. And that's when you go to 1 million very quickly and beyond.
Samson Mow says the market always punishes impatience before rewarding conviction. Over the past few months, he's watched traders chase meme coins and over-leveraged bets, convinced the rally would never end. That kind of euphoria, he says, is always a warning sign. And sure enough, the correction came hard and fast. Billions in liquidations later, the speculative excess has been flushed out, leaving behind what he calls the strongest Bitcoin base in years. Despite the short-term volatility, Mow hasn't wavered from his long-term view. Bitcoin's path to $1 million is intact. The conditions, he argues, have never been better. Unlike past bull markets, where exchanges were throttled by capacity limits, today's market has a new gateway, ETFs. They can absorb massive inflows from pensions, institutions, and retail investors without breaking the system. That removes a major bottleneck and turns Bitcoin into a clean, scalable asset for mainstream capital. Mow expects the move to $1 million to happen in classic Bitcoin fashion. Not slow, not predictable, but explosive. He calls it a Max Payne rally because it'll catch nearly everyone off guard. Traders waiting for one more dip will miss it. Funds trying to time entries will be forced to chase. In his words, Bitcoin doesn't reward hesitation, it rewards conviction. He points to Michael Saylor as proof, someone who buys every chance he gets, ignoring short-term noise because he knows what's coming. Mow says the window for cheap Bitcoin is closing fast, and when it slams shut, it'll happen all at once. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I'm very bullish, and I have a very bullish thesis, but I've been kind of mildly bearish for the last maybe 5-6 months, just because I've seen the alts and meme coins running very hot. And just historically, when that happens, we come back down, and this is exactly what we saw. I think there's been a lot of capital flooding the markets with altcoin treasury companies and the like, and I think it's just been a massive distraction. It was always due to overcorrect, and I think that's where we are at now. And Bitcoin usually will come down with everything else when it comes crashing down. And we hit 107-ish today, so I think this is probably a good correction. Also, we saw a massive amount of liquidations, also largely due to alt speculation over the past 3 days, maybe. I think people were getting liquidated 5 or 6 times, right? The big crash liquidated them, and then they went long again, and then they got liquidated, and then I think maybe some shorted the market, and then we went down again. So it's been a wild ride for a lot of these traders. I think when a lot of this capital is flushed out, that's when we have more solid price discovery and sounder footing to go up on. And I think we got a taste of October, early October, and there's still some days left in the month to go. I think it's just delayed, and I've been predicting 1 million for maybe 2 years now, because all of the factors to catalyze that shift to 1 million are here, right? The previous dull factors for bull runs has been exchanges and their inability to onboard a lot of people quickly because they're bottlenecked. But with ETFs, I think this is the key factor in my theory, is that there is no bottleneck anymore because the ETFs can accumulate any amount at any time because they'll buy on behalf of the users. So you mitigate that retail barrier that kind of stymied previous bull runs. And the matter of the 1 million run is just time, and things can delay it. Like crypto heating up, I think, will always delay it because people allocate capital. Even serious investors might allocate capital. Like I think Cathie Wood was buying Ethereum treasury companies, right? All of that has to come back to Bitcoin. And I think all of it will be very violent. I also have another theory called max pain theory. And that is like the most painful outcome for the most people is the most likely outcome. So if we think that Bitcoin volatility is always going to be low, and we just gradually step up to 1 million and to 10 and to dollar parity with sats, that is the best case for the world. Everyone has a long time frame to accumulate. Everyone has time to buy. And I don't think that's going to be the case. And I think a lot of people realize this. If you look at Saylor and Strategy, he's buying anytime. Like it doesn't matter if it's a top. He doesn't care about dips because there is this urgency because the time is running out to buy Bitcoin at these low prices. So we're going to see a fast run up, and gold is a good parallel for what we're likely to experience with Bitcoin. If you look at the picture circulating right now on the internet, there are people lining up, forming queues to buy gold, and gold is at an all-time high. So nobody wants Bitcoin when it's in the low 100Ks, but once we get to like $500,000 per Bitcoin, I think the world's going to wake up, central banks are going to wake up, and nation states are going to start joining the race. And that's when you go to 1 million very quickly and beyond. It's difficult to say, but I would say sooner than later. So every day I wake up, I'm expecting we're going to see like 100K Omega candle on the charts because it's been suppressed for so long. Like we should probably be at 200,000, I think is a fair market price based on demand. And if you look at inflation, just if you assume inflation, I did a calculation, real inflation is probably 11% or something like that if you base off of eggs. And if you factor in our previous high peak in 2021, we're just keeping up with inflation. So we're kind of tracking M2. We're maybe tracking gold a little bit, but we're nowhere near where we should be in terms of real price discovery happening.
Samson Mow says Bitcoin's volatility is gradually fading, not because interest is dying down, but because the market is maturing. The difference now is the kind of buyers stepping in. Corporate treasuries like MicroStrategy and giant ETF issuers such as BlackRock's IBIT are steady accumulators. They buy regardless of price, creating a constant bid that smooths out swings that once terrified traders. Still, Mow doesn't think Bitcoin will stay flat for long. He sees gold's recent 50% rally as a preview of what's coming, only sharper. The reason is simple: gold supply grows every year through mining, but Bitcoin's 21 million cap is permanent. When demand rises, there's no new supply to meet it, just higher prices. He also sees Bitcoin's future splitting into two parallel tracks: corporate Bitcoin, locked away in institutional vaults, and free Bitcoin, circulating among regular users for transactions and savings. That divide, he says, will deepen as adoption accelerates. Right now, the network is in a quieter phase, partly because more users are transacting off-chain on Lightning and Liquid. But in developing regions like Latin America and Africa, where people depend on self-custody, he expects the next wave of real, on-chain activity to begin, and it'll be massive. Let's get back to the interview.
I would say as Bitcoin matures, we're going to see less volatility. And this is a function of, I would say, two things. One is the Bitcoin treasury companies, especially Strategy, which has scooped up a large amount, and they are a very consistent, a very reliable buyer at any price. The second is the ETFs, the Bitcoin spot ETFs, largely IBIT. And they have also proven to be a very reliable source of demand for Bitcoin. And I think with these two driving forces, it was always bound to reduce volatility, at least in the near term. But longer term, I just don't see Bitcoin sitting idly in this range or even in the 200,000 range. And I think we're seeing a foreshadowing of this with gold, which is the largest asset on the planet, which has skyrocketed and went up by 50% this year. It would be more like Bitcoin's trying to lull everyone into a false sense of security that they have time to accumulate. But unlike gold, Bitcoin is incredibly scarce and finite. There are only 21 million coins. gold production will ramp up as demand increases, and we will see that. And we just don't know how much gold there is out there in the world. It's impossible to mathematically, definitively quantify that, but you can with Bitcoin. So I think we're going to see Bitcoin do its thing. It'll mirror gold, but probably in a more spectacular fashion. So I've theorized about this before, that you might have a bifurcation of the Bitcoin network, or a split between approved Bitcoin that sits in treasury companies or with corporations, and then you have free Bitcoin, which is free flowing, and people are transacting it as money and self-custodying it. And that's still a possibility down the road. I don't think it's a near-term phenomenon, but down the road definitely is possible. But I would say Bitcoin moves in cycles, not the price cycle, but just in terms of adoption and usage. And you see spikes in high transaction volumes, high fees, and then there's mass panic that, oh, it's too expensive to transact Bitcoin. And then you have lulls like now, which is a period of less activity. People are not really transacting on chain. And in part, it could be due to other layers of Bitcoin, like Liquid, like Lightning, or just transacting on centralized exchanges and through custody swap agreements with custodians and whatnot. But I think this is just a temporary phenomenon. And as you get more Bitcoin adoption, especially in the emerging world, Latin America and Africa, where people don't have access to those vehicles, they're going to be forced more or less to hold it in self-custodial wallets, or just a wallet of their own. And that will lead to on-chain usage. But it's a interesting phenomenon. When it's busy on chain, then the sky is falling because fees are high. When it's low, then people say, oh, there's no one to pay the miners and there's no security budget. But I think overall, Bitcoin does manage to balance out both sides eventually. But there is a skewing of Bitcoin development priorities towards layer twos, which I think means we need to make some adjustments to make spam reduction a thing on the main chain too. Because if everyone's working on a layer two, there's not much incentive to transact on the main chain, especially if people are spamming the chain with JPEGs and NFTs, I think, within the Bitcoin community. So there are a lot of discussions and arguments out there about op return and other things. But looking at the discussion from a very high level, my conclusion is it's really coming down to the direction of Bitcoin software node development. Is it hardening it and reducing attack surface and making it sound money, and focusing on sound money, hard money? Or is it adding more programmability? Because that's just the root of the issue, right? A lot of these changes, like the removing of op return and removing of filters, is to encourage or help layer two protocols that require new things. There are a lot of layer twos that don't require new changes to Bitcoin, like Liquid, RGB. Those are two. But there are new ones, and there are theories of more in the future that will require more changes. And if you look at Bitcoin core development, they have a lot of soft fork proposals out there to add more programmability to Bitcoin. And I think this kind of is at odds with the idea that we're hardening, fixing bugs, fixing security issues, and kind of hunkering down. So this is really the divide. And I don't think it's going to kill Bitcoin. There are obviously people that are saying that, but it's more of a directional thing. And I don't believe there's ill will from the core developers. It's really just different priorities. There are no soft forks to fix spam or reduce bloat on the main chain, but there are a lot of proposals for soft forks that restore opcodes, restore more programmability, more expressiveness, moving towards more Ethereum-like capabilities for Bitcoin.
Momentum in Bitcoin's story isn't being written by hype anymore. It's being shaped by conviction and structure. What's unfolding now feels less like a cycle and more like a transition, where volatility no longer signals weakness but maturity. The players entering the space, public companies, institutional funds, and long-term holders, aren't gambling, they're reallocating. The speculative froth that once defined crypto markets has given way to disciplined accumulation, turning Bitcoin into something closer to a monetary cornerstone than a trade. The infrastructure, from ETFs to global custody solutions, has quietly prepared the stage for a surge that doesn't need headlines to sustain itself. And when that next leg higher begins, It'll reflect years of groundwork rather than weeks of hype. As traditional capital continues to bridge into digital assets, the real question becomes, will investors recognize this moment as the calm before the breakout, or mistake it for the end of the story? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.